Hi, everybody. How's everyone doing today? Everyone doing all right? Hi, Glenn, Forex Gal, everybody. Want to welcome our viewers from investing.com. Of course, we know last night, the House impeached President Trump, but that's not what really has me blue about Christmas coming up. We're only going to be here next week on Monday. Okay, the rest of the week we're closed. And I just started thinking about that today, and you know what? I'll have a blue Christmas without you. I'll be so blue just thinking about you. You'll be doing all right with your Christmas of white. But I'll have a blue Christmas.
Nice.
And so will the S&P longs, because people are waiting for January 1st sell to take profits. And in thin market conditions, pretty good time for a bear raid. 4-hour chart. I know I'm the boy. I'm the Elvis that cried wolf. But look at this. So I know, how could it be that easy just to, sell the market after an impeachment? Something that's going to give you a clue, and I'm really surprised the yen has not taken out the stops over these highs yet. It could still happen. And oil, I'm still hanging tough. I still think that when S&Ps come off, oil come off. I saw a count that we could be setting up for wave 3 of 3 to the downside. I'm not an Elliotician, but I see this. I see 1 confirmed high. I see 2 diverging. And if they take a shot up one more time towards 61.5, I think it's a sale with a buck stop or so, where I'll be looking to add. And the dollar still, as long as we're above, and I talked about this last week, it's kind of this 97.09 level when you look at the daily, double bottom here, right here. We flushed the stops last week. Oh, look, I've got a mystery offer. All right, and we're above it. So as long as the dollar is above 97.10, you have to respect that at least it could correct this decline. And who knows? I mean, forgot the name of the guy that David mentioned about year-end problem with the overnight repo rate coming. And, if we get some type of spike in rates, and, we're on the precipice of it doing it. Someone sent me a 10-year chart. I'm looking for one more low, and I thought we could get to 210. But if you look at this right here, and after this, I'll turn it over to Blake. But something like this, looks like an ascending triangle here. We start breaking out over 98 with a low of 40. Then you're talking 230, 240. That would be I think a problem. Look at the weekly for the markets. So you have, this was a big breakdown right here, but so was this at 220, 230. So if we get a spike in rates, that should take the yen above the level. So we'll see. Anything can happen in these thin market environments until January 1st, when people come back and get ready to start 2020. So this is a pretty key thing. And keep in mind that it's not going to take a lot of volume or to make pushes, to play games. You've had all kinds of spikes happening this week, like in crude oil. Look at these spikes. you have this, this happened out of nowhere yesterday. So be careful until January where liquidity returns. And to me, it looks like if we could just start trading back under 60 bucks in the crude, whether we make another high or not, that's going to be a pretty good indication, another false breakout. So Blake, I know you're going to be surrounded by people that love you on Christmas. So I know you're not going to have a blue Christmas unless you drink too much.
No, I just Christmas is always a fun time of year for us because we made the physical move back to Phoenix, Arizona about 8-9 years ago, and specifically to be with family and
Nice.
and friends and let my kids grow up with their grandparents and cousins and nephews. So
Good trade. One of your better trades, right?
It's I had to sacrifice a little bit of sleep to make that jump, but for me it's all worth it. So Christmas is typically a pretty good time of year for us. It's our favorite time of year. So
okay, blue, none of that. All right.
Yeah. So
blue, the only thing you're blue about is the lack of volatility.
That's correct. It's still the same old story, and we expect a lot of the same going into the year end. I mean, this has been it's been a very slow market this week. We had some central bank meetings last night with the Riksbank, Norges Central Bank, Bank of England just now. So it nothing creating too big of a stir, but the cable did spike above. You can see here, let's just go over to the hourly. You can see we spiked above the highs and then right back down. The pound is approaching my buy orders, and I know you're probably thinking, wow, so you're I think some people out there are probably thinking, wow, you're thinking about buying here. But remember, 30, 15, 30, 130 level was a huge level of resistance. And when it broke massively. And so I'm assuming right now, and you can see this chart right here, this little push below support, which would be below today's lows at 30.50, will trigger my order. My assumption would be that there are stops here and let them get triggered and then, take it up again. And that's what I think is going to happen with the cable. I think this is the levels that you want to be long. So we'll see if we can dip down there to take advantage of those levels. I'm kind of thinking that everybody is waiting for that trade. So, when everybody's waiting for that trade, maybe it won't come to fruition, but that's what I'm thinking at this point. The euro dollar has been, disappointing. I mean, it's been a disappointing for bulls and bears. Let's talk about that for a minute, because if you're a euro bull, which I am, I'm looking for the euro to get a sustained break above 112 eventually, but I'm really wanting to play long when it gets up here. The reason why it's disappointing is because it can't get over the 200-day moving average and stay above the 200-day moving average. If you see the 200-day, which comes in right now about 111.50, any rally up there, it's getting swatted right back down. Now, the flip side of that is if you're a euro bear and you believe the euro should be going a lot lower, you're looking at President Trump and you're like, wow, he's going after the EU next. You've got all these problems in Europe. There's no way that Germany is going to unleash more fiscal stimulus. If that's your, if that's your opinion, you're probably looking at the euro going, man, this is a great short right here. And you're probably pretty frustrated that it's not dropping. So, I look at it from both points of view that, yes, I think it is a very frustrating currency pair. And, one that, frankly, I'm obviously watching every day, but I'm not paying really close attention to until we get a close above, this 111.80, 112. We get a close above there, and I'm going to be really interested. Flip side to that is, you know, maybe a dip back down towards, you know, 109, 109.90, 110. You know, I'll be more interested on the long side on a dip down there. But you can see we're in a 200 pip trading range, or maybe even a little less than that. And, you know, what do? Probably not a lot at this stage, guys. And you're gonna have to excuse me. I'm not feeling 100%. So if I sound very nasally, that's the reason why. And I got some sniffles and trying to get past it. I actually ended up ditching my evening plans with my kids and went to bed early last night trying to get over this. But anyway, that's neither here nor there. But dealing with the euro dollar, you know, 111.50, 111.80, that's really key resistance. And, you know, support's down at 111 right now, and then, you know, maybe down towards 110. I'm not too terribly interested with the euro at this moment. Now, one of the things that happened yesterday is if you look at the Kiwi dollar, the Kiwi spiked up following the stronger GDP numbers, but then it got quickly knocked back down following the GDP numbers yesterday. That was right here, actually. You can see it rallied, smacked right back down. One of the things about GDP numbers I always try to take into account is that those numbers are in the rear. So, you know, people are looking ahead past the GDP numbers. However, the Australian employment numbers came in pretty strong last night. You can see the Aussie spiked up and has maintained most of its gains. The one pair that I traded yesterday is the Aussie New Zealand. If right after the GDP numbers, we dipped down. I mean, we dipped quick. I mean, I saw it go down here, but it didn't, you know, go down there too long. It dipped down to 103.70. I picked it up at 103.84, and then I sold it at 104.30 something, right back over here. And the one thing about the Aussie New Zealand is it created a little bit of a false breakdown right into channel support. So, and this is a 78% retracement. So I've been trying to play this little zone here in the Aussie New Zealand. I don't have it. I'm not long now, but I'm just, you know, if you were in the chat room last night, right after the GDP numbers, you knew I picked it up, and then I, you know, sold it about, right after the Aussie numbers, a couple hours later. So, and you know, I'm just looking for opportunities like that. I think there are some, you know, opportunities in the market, you know, that are at this point non-dollar related that we're seeing. One of the other trades or one of the other big charts that's really sticking out to me right now is the US dollar Canadian. We are on a multi-year trend line support. Okay, going all the way back to 2017. So this is a daily chart, right? So 2017 low, 2018 low, 2019 low, I guess pretty damn close to low. Not quite, but pretty close. And then to current prices. That's right here at 131. You know, we've been kind of probing these levels, and you can see how the 4-hour breaking lower in price, relative strength is not. So I think the US dollar Canadian should find some support down here. Will it, you know, hold as support? You know, well, we have so tomorrow, just so you guys know, tomorrow we have Canadian retail sales. Maybe that will be the catalyst that drives it lower on a strong Canadian retail sales number. That's entirely possible. We saw the inflation data came out yesterday, and that strengthened the dollar Canadian, or strengthened the Canadian currency. The dollar Canadian fell into support. So if it's a miss, if it's a Canadian retail sales miss, then this is in my opinion, a very good risk reward long trade on a Canadian miss tomorrow. Now that doesn't mean that we're going to get it, but that's what I think we need to be paying attention to going into tomorrow, tomorrow's numbers. But it is. Let's also take note that this is the week before Christmas. The Christmas holiday is less than a week away. Tuesday is Christmas Eve. Next week is going to be extremely, extremely slow. And also, I have to mention to you guys that we will be broadcasting on Monday morning. And if you are a ForexAnalytix subscriber, okay, the analysis on ForexAnalytix after starting Monday is going to be very light. So in other words, unless you see a move that has that looks like it's developing, or there is a explosive move in the market that no one was expecting, and something that is happening, that's when you're going to get the updates. You will not be getting normal daily updates on throughout next week because of the Christmas holiday week. And then the day after Christmas, going into the weekend, if Christmas is on Wednesday, Thursday, Friday is going to be there's going to be virtually nothing happening. So next week is going to be very, very slow with updates. I'm giving those of you that are ForexAnalytix subscribers just some fair warning. We push alerts and to explain that it just happens every year. Every year around the Christmas holiday, things just get really slow, and even the following week between Christmas and New Year's is going to be pretty slow as well. That's just tis the season. Hey, by the way, crude oil is really pulling back here. Dale, you had your eyes on crude. I don't hear Dale.
Buddy. Yeah.
Oh, there he is. Crude is really peeling off here intraday.
Let it be. Well, what? It's down 12. Yeah.
Yeah, I mean, for an intraday move, I guess.
Oh, okay. Yeah. See what's happening to us.
I'm getting excited about some very small moves in the market.
I know, it's like we had a guy, one of our attendees said, gold is crashing. And then Steve and I looked and it was down 40 cents. So we're getting so preconditioned that, anytime there's a semi-normal candle, we go, wow.
Right.
This is what action?
Right, exactly. Hey, speaking of which, the euro is actually coming down. Let's see if the pound can take out the 50 level. Let's see if we can do it. We might be able to do it while we're on air. So let's see. Come on, take it. Do it. Come on, take those stops.
Where under 30, 50?
I'm begging for my bids to get hit. Come on,
Where,
here we go.
31.
Here we go. 25 actually.
Okay, yeah.
Let's see it. There we go. Good. Stops are getting taken. It's finally happening. Let me reset that. That's all you're going to give me? Come on. You can do better than that.
The 1 hour is diverging kind of.
Huh?
The 1 hour is diverging a little bit.
I got to pay attention to this intraday stuff. I got to see if we can dip all the way to 25. Come on. 15 more pips. You can do it. Like I said, there were some stops below 130.50, but that I'll be shocked if that was it. And that might be it.
Sometimes stop hunts are only 10 to 20 pips above or below stop, swing high or low.
No, usually yes, but the reason why I'm saying that is just the rather illiquid markets. I was thinking that we might actually get a little bit more than that, but
you'll get it.
But we'll
Patience,
see.
My man.
Yeah, we'll see if we can drive it a little bit lower here. I think it's entirely possible, but it's gonna irritate me. What's gonna happen is it's gonna come now. 14 pips for my order, and it's going to rip all the way back to 131. And
when you think about it, limit orders, Blake, it's like you have to go through all the anxiety of of getting filled to have the anxiety of having a position.
Yeah.
Do you know what I mean?
Yeah.
I'm kind of a market order guy. You know, if I want in, I don't care. You know, I'd rather not have the stress of knowing whether or not I'm going to get filled at a price. That, you know, because I'm impatient.
Well, I mean, I put the order down there and just, you know, it's
Yeah,
like,
I know.
come get me, you know,
But right now, don't you feel like just in case, like maybe you just put a small piece on, and then if you get okay.
No, I try not to.
All right, you're more patient. You're like Volgy.
If unless it's like I've got super strong conviction, and being it's the end of the year and
you're
it's
just finessing
holiday
things
week,
here.
You know, going into Christmas holiday week. Yeah, it's like, why am I going to do that?
Hey, did you watch the impeachment proceedings at all?
Not even one.
All right, because I tweeted the face is a lot like the impeachment proceedings because you and Stelios are always forced to yield your time to Steve and I because we interrupt you. So that's what the whole thing was. I yield my time back. I yield my time back. You guys always have to yield your time back. Like right now. See, I just, interrupted.
So, hey, good morning, Stel. So really quick, Deepak asked about the dollar CAD, and I think he got my view here, regarding the dollar Canadian. We're here, and I don't think there's anything to do going into this weekend or into Friday. You got to wait for Friday. You got to wait for the retail sales data. You can obviously take a shot at it here if you really want to try to position yourself ahead of the news, which I do a lot of times when there's more liquidity. So, like a lot of times I'll position myself, like, for example, I believe that we're going to see a bounce here. So, I think by tomorrow we'll be trading, maybe 130, 140. So I'd try to get long a little bit down here, and and hopefully it bounces ahead of the retail sales number. And if the retail sales number is weak, then I've already got a nice running start as it moves higher. But because it's, there's not a lot of liquidity this week and moves are pretty tight, I don't know if I really want to expose myself. Cable's near its lows of the session. Come on, pound. Do it. Get there.
Get your pom-poms out.
I got some pom-poms going on. All right, let's do it. So Stelios, good morning. I heard you.
Good morning. How are you doing?
You want to tell us about the Queen's speech today? Just kidding.
I've got a few things to say. So
you do. All right, let's hear.
Ready?
Let's hear what you got.
Okay, first I'm going to sing Merry Christmas. No, I'm kidding. I'll leave the singing to Dale. First of all, Trump and the impeachment. The Twitter was all over it. 1 in 2 tweets I read was about the impeachment. We have to remember that it's one thing for him to get impeached, and another thing to get 2/3 of a majority against him in Senate. It's just, I think it's less than 5% chance of that, and I think I'm marking it high as well.
I think you are too. Yeah.
Yeah. So and actually, interestingly enough, House Speaker Nancy Pelosi, she didn't actually commit yet that the articles of impeachment are going to be sent to the Senate. So it shows, they want to, she wants to get him impeached, and he got impeached, but really she knows that there's zero chance or near zero chance of anything coming out of this. So I don't know how this is going to continue, but I think one thing's for sure, the markets are paying very little attention to it at this point, and quite rightly so, because it is, as I said, a very low probability chance.
Yeah, so FX market does not care. Yeah, market, exactly. And the markets in general will care about rates. They're going to care about where interest rates are going. They're going to care about earnings. They're going to care about GDP growth. They ain't going to care about impeachment. And now, not at this stage. If Trump was actually removed from office, and let's say that your 5% chance happened, which it's not going to, but let's just say it was, and he was removed from that's a different story.
Oh yeah.
All it would take is Bolton testifying in the Senate trial. Well, that would change everything. One witness would change everything.
Yeah,
I know everyone thinks it's a lock and nothing could happen, but just like the markets, when we think everything's certain and a lock, there's always a chance of something unknown happening.
That would be what we would define as a black swan event.
Yeah, I guess. Yeah.
Yeah, it would be. But like I said, and I'm sure you both agree, and Steve, I'm sure, is listening in.
Oh yeah, Steve. Steve, unless something moves the market, it's not important.
There's nothing going on here with the impeachment hearings, and it's not
just the beginning of civil unrest in the country. That's all.
Here goes the cable. Come on, 10 pips. 10 pips. Give me 10 more pips, please. We're going. Bring it.
Now use the cursor technique. You put your
put my cursor and it's going to go there. Is that
drag it down? Yeah, everyone will do it with you. 1, 2, 3, down.
We're almost there. Come on, trick my order. We're like literally 5 pips away. Almost there, folks. Almost there.
There you go.
There we go. And I got hit.
Yeah. Good patience.
Patience is a virtue. Well done.
It was me doing you a favor. I just sold 5 million to give you hit.
Nice. Nice. All right. Well, there we go. Let's see if it can bounce now. Hey, Steve. Good morning.
Good morning.
Forex Gal said I put my cursor there. Oh, me too. Look, I put it there and it went. Dale,
now you drag it the other way. Now you drag it.
Yeah. I'm going to put my cursor up here. Okay. So let's see if that works.
I used to sell that system for $9.99.99.
I guess our service is completely worthless now.
What? All you need is
you just need the cursor method. Look,
you put a magnet on the screen. I've used that before too.
I
hope
you haven't used it in the old CRT screens, because it would actually do something, destroy the screen.
Yeah, I did. Anyway, the trade worked though. Well,
all right, guys. Hey, I'm gonna let you guys address the rest of the questions. Have a great day, and remember, 'tis the season. Make sure you visit our webinar sponsor, Forest Park FX. They are the ones that are going to be able to help you find a broker that's best suited for your needs. If you're not happy with your current broker, or you're not getting reimbursed for your trading, join the reimbursement program. Get some cashback rebates if you're not if you're in the US and you can't join the reimbursement program, but at least be getting something. So make sure you reach out to them so they can, and like Steve said yesterday, there's a chance that you don't even have to switch your brokers. You just have to, you have to make sure you have the right paperwork signed, and then you're good to go. So I'll let you guys go. Have a great day. Good luck, everybody. Let's get the cable back up to 131. I'll talk to you guys soon.
Okay,
Blake. Thank you.
Bye-bye, mate.
Hey, Steve. All right. I have a couple of more things to say, or is it one more thing? Actually, the UK. So we had the Bank of England interest rate decision, 7-2 split for unchanged, 2 vote to cut, the same ones as last time. No surprises. There's no press conference, so we didn't get any more information. We did get retail sales though, and it was negative. So another bad print, and it's a pretty big string of negative numbers now in terms of retail sales. Kind of to be expected, like we said before, with this whole thing, the whole Brexit thing still not getting any closure. But hopefully we will get there eventually by, December 2020. Apparently is there's going to be no extension up after that. The Queen has made it law, end of story. So let's see what happens with that. Now, there was something very interesting actually out of the UK. And again, it wasn't a good one. Did you read about this Bank of England scandal, Steve, today?
About the press conferences?
Yeah, so apparently they have this backup audio feed for the press conferences, which is supposed to be a backup. Obviously, there's a video feed and everything, and these funds and other clients were paying good money to get access to this audio feed, and nobody wanted to ask why. And apparently, it had an 8 to 10 second advance in terms of speed. So some people were paying, thousands of pounds to get all the information, 8 to 10 seconds. earlier.
Which
I mean,
is more than enough for
they,
your algos to go do the.
they need
Yeah.
8 to 10 milliseconds or microseconds, really.
By the
Seconds.
way, we just got, sorry to interrupt you,
Yeah, yeah.
we just got data. Continued jobless claims a little bit higher, initial jobless claims a little bit higher. Another bad print from Canada,
Yes.
Canadian wholesale trade minus 1.1 versus minus 0.1 expected. So we keep on getting like abysmal data from Canada for the past few weeks. And
Yeah.
for some reason, I don't see the Philly Fed number.
Me neither.
The rest have come up immediately, but I don't think they've announced it yet, probably. Oh, there it is. It's just 0.3 versus 8 expected. So it was a huge miss.
Yeah, big miss. Yeah.
0.3 versus 8 expected. Okay, that's quite a huge miss.
Yes, indeed. Oh yeah, the one last thing I wanted to mention, we had the two Scandinavian central banks today. Norges Bank kept rates unchanged, but the move was from the Swedish central bank.
Swedish
Riksbank.
central bank.
Yes, it was kind of expected. They went from -0.25% to 0%.
To 0.
I mean, it's
the market had already priced that in,
yes.
and if you see the USD SEK actually, in expectation of that which was priced in, it rallied yesterday, and today, although it was weaker on the day, which means that SEK was stronger, it has now rebounded and it's completely unchanged. Having said that, I still believe that near 950 is going to be a good opportunity to resell for whoever has taken the initial trade. I think it still looks good, and the USD NOK is still pushing lower towards the first soft target here, and the more important one is at 880, 882. I think we can actually do it. And EuroNOK is also, speaking of that, and I'm actually going to go through all the European pairs because the vast majority of them, interestingly, are at quite important levels, at least half of them. So EuroNOK is still doing its thing, moving lower. So this is the trades I have on. So no complaints there. So any language from the
From
Norwegian?
Riksbank?
Yeah, and Riksbank?
No, nothing major, no. I mean, the only thing we can take away from this, in my opinion, is that the Swedes have basically thrown in the towel and they're saying, look, negative rates are not helping in any way, so they're going back to zero. Yeah, exactly. So they're going back to zero. Remember, Sweden is also one of these countries they've gone cashless, I think, almost completely. So they're trying a few things, and negative rates is clearly not one that's working. So I think that's all we can take away. And people are talking about this being an example and the first step towards going to at least zero rates for other countries like Switzerland and -0.75, and
yeah. Although we're still talking, unfortunately, about zero nominal rates.
Oh yeah, of course.
Because
real rates is very negative. Yeah.
Because real rates are very, very negative, especially if you consider the real inflation, which is being underreported, as we've explained multiple times. But even if that was not the case, even if we take at face, the reported inflation, it's still that even in the US, real rates are negative. So we've been constantly since more than a decade ago in a very peculiar situation that we've had real rates remaining negative. We went through one of the biggest recessions, then expansion, and sooner rather than later to the next recession, and we haven't managed to get off negative real rates. And Austrian economics simply explain how much that destroys an economy by creating like huge malinvestments, and we see that around us. I mean, you get a banana sold as a piece of art, and, and
a
some
guy eats
BS.
it, yeah.
Yeah. Yeah, and things like that. Yeah, that's when money doesn't have where to go, and that's what happens.
Yeah.
Okay, anything else from the macro perspective before we
Well,
dive into
that's about
Catalan?
it, my friend. That's it.
Okay, cool.
Right.
So we have a question about Euro Kiwi. As I said,
Thank
I
you,
would.
Stel. As always, good.
Thank you, Dale.
Yeah, you really keep us informed of what's happening. When I wake up in the morning, I don't know what's going on. To me, making coffee is an accomplishment. 4 in the morning. You know what I mean? All right.
Cheers, man.
I got to move to Greece and do face in the afternoon, or at least do it for a few months.
Man. More than welcome.
You keep
I
saying
may have to run away from California. All right. All right. Have a good one, buddy. Now we'll let Steve, who we always have to yield time to, because Steve and I are interrupters.
Yeah.
Steve, the floor is, I yield my time to Steve Volge. That's what a congressman do.
An interesting question, by the way, just came in. Cad Knock, and you know something, it is an interesting question because I haven't recently had a look at it, but I was recently looking at the NOCSEC. So, okay, last time I had a look at the Cad Knock. Yeah, it was here. So, you know, this is what happens when you break through a range. Just look at that extension, right? We were back here. I said that, you know, perhaps we're going to go lower from there. A lot of time passed by and we were like oscillating, and look what happened once we broke through this well-defined range. I mean, we got like a big move higher, and now we're clearly getting some type of a corrective move lower. So the thing is, what kind of a move is this? Probably corrective, right? I mean, judging from the kind of move we had before, so this is probably a corrective move. And how would you trade it? The problem with corrections is that it's very, very hard to predict the end, but this might easily end up being a pennant of some kind, right? So yeah, I think I think it's going to give another opportunity to be long, at least, you know, looking at the chart at the moment, unless we start accelerating lower and we go through this area, then we can be talking potentially about, you know, like a real reversal. But until then, I think we should, you know, treat it as a corrective move. But I was also having a look before we go to the Euro pairs at NOCSEC. NOCSEC actually has been very, very interesting because it was trading within this triangle. You can see it. I mean, resistance dates back to 2012 and support dates back to 2015, at the very end of 2015. One more example, by the way. This currency pair bottomed for years, January the 4th. And that was the first trading day of that year. So one more example of seasonality as we've explained it. So it bottomed back then, and, you know, it's been since then almost 4 years now, and that was the low, you know, a multi-year low. But we broke through this triangle and we've now rebounded, you know, quite impressively. But look what we're testing. We're now back testing this. So I think it's interesting to see what the NOCSEC is going to do from here, because it's going to tell us, you know, if the SEC is going to keep overperforming the NOK as it has been doing since May of 2019, or that can actually change. Okay, so NOCSEC at quite an interesting level. I mean, I frequently have a look at these kind of pairs because, you know, they can get you away from, you know, the trap of, you know, waiting for news that might affect the dollar or whatever. So, you know, sometimes it is, you know, ahead of big news or big market decision. It makes sense to trade, you know, pairs like that, or the Euro NOK, for example, that I now traded, you know, which has more esoteric reasons of doing what it's doing. Now, speaking about the Euro pairs, Blake already mentioned that, of course, the Bulls haven't managed to, to win the battle of 112, and that is pretty important. On the other hand, we haven't had any real follow through to the downside as well. So we keep getting rejected from this trend line. But so what have we done? We've done nothing. I mean, so I think that 110.80 is support, 111.80 is resistance. So we're currently trapped in that range, and until something happens, of course you have to keep respecting the downside as long as we are below 111.80. But not much to do. There are other euro pairs though that are at interesting levels. For example, the euro Swiss. So the euro Swiss has been consolidating. Initially it started like as a megaphone formation. Now it has developed to a triangle. Combination of a megaphone formation and a triangle will give you a diamond formation, right? Which can act both as a continuation or as a reversal formation. So something, let me take the magnet off, something like this. Okay, so we have something like a diamond formation here. So sooner rather than later, we're going to have some kind of a resolution. It is a decent chance that it's going to be to the downside if we get some risk off. On the other hand, of course, we know that, being short the euro Swiss, you have the central bank, the SNB, the Swiss central bank, more or less going against you because, they keep the euro Swiss supported, but still, it is a formation worth noting. Now, euro Aussie. Look at this. Euro Aussie keeps riding this ascending wedges, trend line support. We got supported once again last week. We were testing it for 2 consecutive days. We rebounded, but look at this. I mean, this 163 and change resistance area is also holding. So this one is also trapped in a range. Needless to say that if Euro Aussie actually manages to break below this previous low, I do think that there is going to be continuation lower. And if you have a look at the Euro Kiwi looks even more bearish if it breaks down because it has also stopped. Look at how many days we have been testing this support, and we found resistance up there. And so far, this looks like a bearish consolidation right on top of a very important trend line support, right? So if we do break below this, I'm pretty sure that we're going to see lower levels quite faster. So I have to say that I'm just short the euro NOK, but I have to say that many of the euro crosses look quite heavy as well. EuroCAD as well. Look at this trend line that it's currently testing. I mean, this rebound higher looks corrective in any kind of way you want to look at it. Look at the RSI trend line support as well. And it's currently testing support once again. So, I mean, I don't know. This looks like it wants to continue lower as well. So, I would very much want to see the Euro USD break above 112 because I'm pretty sure it would create quite an interesting squeeze higher. But, the rest of the Euro crosses, they look quite heavy. The Euro NOK has already broken, below this. Let me mark it also. Look at this. This is obviously an important horizontal support area. It was also these wedges because we had 2 potential wedges, trend line resistance for some time, and then we retested it as support. It held initially. Now we broke through it. So as you see, the vast majority of them is pointing lower. Okay. So this Euro MXN also, I forgot to mention the Euro MXN. Look at this. The Euro MXN has also been trapped in a range. We've been testing this trend line support since April, mid-April, and we're down at it once again. So, you like it to the long side, this is where you buy it, obviously. I mean, from a risk reward perspective, it looks magnificent. But you don't want to be in the wrong side of this trade if it breaks lower, because you can imagine how many stop losses there are down here, right? Let's say below 21. So you like it to the upside, you buy it, you put a stop loss below 21. But if 21 breaks, as you imagine, there are more people that have their stop losses there. There's going to be there's going to be a squeeze for the longs, and Euro MXN can end up trading down at 20 and change, like in very little time. So as you see, the vast majority of the Euro pairs are striving to hold the important supports or are breaking down or whatever. So I can't just dismiss that. So it makes me more cautious about the fate of the Euro USD as well. Of course, the Euro USD can break higher and the rest of them breaking lower, because the USD can end up selling off against everything. Just other things might be overperforming the Euro, but in that case, why would you be long the Euro USD if that is the case? I mean, if dollar is breaking down and Euro pairs are breaking down as well, it means that the Euro is not the strongest currency you want to be long against the dollar, right? That means on its own that there are better opportunities being short the dollar besides Euro. So, even if you want to look at it like that, if those Euro pairs break down, it means that, even if you want to be short the dollar, you should be doing it with, with some other currency. Like, for example, I'm short the dollar, being long the NOK. So that's what I think about it. Oh my God, there is a joke that I'm pretty sure just from the beginning that it's politically incorrect. So let me read it. No, I'm kidding. Okay, yeah, I can't read that. It was funny though. Okay, let's see if we have any questions. USD CAD, yes, USD CAD. So stubbornly, very stubbornly, USD CAD is, first of all, stubbornly keeps hiding itself. There it is. So stubbornly, USD CAD is still trading within this. You can't exactly call it a range because it's a slightly ascending channel. But 130.50 is support, 133.50 is resistance, roughly. So we keep getting horrific Canadian data, and we keep trading lower within this range. So admittedly, it's quite interesting that the USD CAD is actually moving lower despite getting very, very bad data from Canada. But from that to actually seeing a breakdown to 130.50, it's a totally different story, right? So as I've said before, I think that everything between 130.50 and 133.50 is noise. So since it's noise, I think that initially the best thing you can do is attempt to buy on support, because you're going to have a very good risk-reward ratio, and see what you get from there. Now, obviously, if you see a move below 130.20, for example, that low, you don't want to be anymore on the long side of this, because it can actually end up breaking down, and looking at the big picture here, it can really break down. I mean, imagine if we start getting some good data from Canada, or dollars starts throwing up all over the place. I mean, we've seen the dollar underperform the CAD during the past few days with bad Canadian data. Imagine if we see dollar weakness. I mean, this can actually break down and then start triggering stop losses. So it's going to be a mess if you want to be long. But above 130.50, and the closer we get to that, I think it's worth a shot, because we've been trapped in this range since summer, so it's almost 6 months. So who says that we can't remain trapped in this range for another 1 month, 2 months? Who knows?
Sounds like crude.
Crude, speaking of crude, I wanted us to have a look at crude today on the 4-hour chart, actually. And you'll see why, because on the 4-hour chart, we can see in more detail both this trend line, resistance, and this channel.
One's at
And,
resistance and one's at support. Short crude by Canada, USD CAD. That's
and
my Christmas piece of coal.
And as you see, we are getting very, very close to the confluence of those, right? It's like 50 cents higher. So
yeah, 1.5.
I still think that this whole move higher clearly lacks impulsive characteristics. So I still believe that the closer we get to that confluence, the more appealing the risk reward is to be in the short side.
How about this, Steve? It bottomed early January this year. It peaks early January this year.
Guess what? Seasonality.
Yeah, how about that?
Right?
So normally, I mean, and Greg is the one that pointed out that
look at this.
The
low in crude was 24th of December.
Yeah.
So if you keep noticing, as I've said, seasonality is a real thing. I mean, the chances of finding a high or a low at the very, very last or very, very few days of a year are much, much higher than statistics would explain as a percentage of the days of the year.
Oh, Jake Bernstein was on this, I don't know, 30 years ago. You ever follow him? Remember him?
Yeah, I do remember him. Yeah.
Okay, yeah, that was a real big part of his analysis, seasonals.
No, and I do agree, seasonality does play a role. Now, should you be trading solely on seasonality? No, you shouldn't. But should you factor that in your decision making? Yes, you should. For example, if you remember, Coach, I don't know if you were here because sometimes you take small breaks. I was mentioning that statistically speaking, it's one of the best established seasonal trades. We know that the first year of a presidency is the weakest in stock performance. So, for example, I was mentioning that I think either yesterday or the day before.
It wasn't for Trump.
No, it wasn't for Trump. Yeah, it wasn't for Trump. That is true.
No, it exploded after the election.
It exploded, but seasonality
after
doesn't.
Being limited down that night in Carlisle.
As you know very well, seasonality doesn't mean that every single time the same thing is going to happen. No. But it means that you take an average, and you say that on average, the first year of a presidency is, worse performing than others, for example. So, in this case, if they manage to, to keep, kicking the can down the road successfully for another year until the elections, that would actually, align very well with what would be by then a 12-year-old recovery based mostly on financial engineering, on monetary of lunatic monetary policy, of deteriorating actual economic fundamentals. And if you think about it, Trump will have less of a reason to try to stop the inevitable then, because he will have another 4 years no matter what, unless he manages to actually get impeached, and go all the way. Because in this case, as I've told you, I think there's no chance that this is actually going all the way. I think that something like like it's, in my opinion, it's not a 5%. It's like a 0.1% chance that the Senate will actually go through and remove him from office. So I think it's going to be a non-event. But yeah, it is what it is. Now, do I think that they're going to manage to kick the can down the road for another 1.5 years? For another year, I mean, sorry. They'll need to have some luck as well. They might, but they'll need to be lucky as well. So now, having to do with USD yen, we have a friend asking, if you remember that I mentioned yesterday that once again, USD yen is testing this trend line and guess what? It's getting rejected once again today.
Very
so far.
unusual that it didn't take out the stops. You know how many stops there are over 70?
Oh, for
I
sure.
mean,
There are
going
a
back
lot.
to the end of November, and then the last 3 times we've knocked at the door and not taken out the buy stops.
Yeah, I mean,
What's wrong with these algos?
Yeah, yeah, somebody has to wonder, right?
They're on holiday or what? What's going on?
I don't know. Perhaps, yeah, perhaps they're on a break or whatever. Who knows?
Yeah.
So yeah, I mean, we're getting rejected once again. So you know, you want to be short, risk reward is in your favor. For a move, as you see, you know, we've placed like an alert here below these wicks. I think we can just, you know, keep oscillating within this range, especially during, you know, Christmas period. You know, that's a real possibility. Now, having to do with stocks, just look at this. I mean, volatility has gone back to zero. Just look at this. So far, of course, it's very, very early on the day, but look at the previous 2 candles. I mean, it's like the market has switched off completely.
You know, Steve, take a look at the VIX, and on this last push up in the market, the VIX actually filled an intraday gap. Okay, you show it. See how it filled the gap about 3 candles ago?
Yeah, it did.
You know, and now we're back above that green line.
And it's still diverging, by the way. Although we are at all-time highs, although we've spent the last 2.5 days literally doing absolutely nothing, the VIX is still diverging.
Yeah, I like it.
Yeah, same here. And I'm only...
We get through there, yeah.
Speaking of which, how many days away am I now from winning the bet against Ures? I'm really looking
January
forward.
1st?
Yeah, I mean...
what was the bet? It wouldn't be 10?
That we wouldn't... that I told him we wouldn't see single digits again during this business cycle. He said, come on, I'll make it easier for you. Let's just say for a year. And I'm like, okay, sure, you know, for this year.
What do you bet?
So, you know, dinner. Dinner at a good restaurant.
You'd bet $1 like the Duke brothers in...
No. Dinner at a good restaurant.
Okay, are you Eddie Murphy in this one? Anyway, the Duke
dinner
brothers.
At a good restaurant. So I almost can smell it now, right?
What are you going to have?
Oh, I love meat. I have to tell you that. I love Italian food and I also love meat. So, you know, any of the two.
Okay.
You know, good meat restaurant or Italian.
What kind of meat?
Oh,
lamb? Beef?
Meat. Really, I'm a meat lover. I just, you know, anything that's well prepared, you know, I'm gonna eat it. I mean, I eat meat with its blood. I know it's...
so you eat everything pretty rare. Like a steak would be bloody for you.
If it's good meat, maximum medium rare, yeah. Maximum,
I know they had vampires in Greece.
Indeed. That's one, that's one here.
Right, I have to say the monthly in the end looks good.
Looks like it might, you know, something. Of course, it might break to the upside. I mean, it keeps testing this, and you can still view this as an inverted head and shoulders formation, right?
Show the monthly for the guy. Yeah, maybe we get one more break. We don't make new lows, and then we take off. And is that the monthly end?
No, this is the weekly, but there is still a bearish argument in the weekly, and this is what I pay attention to.
Yeah.
And it's this one. You can see it here. So if you take into account this trend line, look at this. We're also finding resistance at this trend line, and sooner rather than later, those 2 trend lines are converging in this area, right? At 110.30, you can see it here. So I have to tell you that without even going to the monthly, you know, even looking at the weekly here, you know, I would at least want to see a break above this trend line resistance, because this trend line resistance is major.
Oh, we fail from here. There's your case for 1,700 gold.
Oh yeah. Oh yeah.
So,
if we fail from here, as you see, what I've drawn here
and new lows and yields.
If we fail from here, I think we're going to be retesting the 100 lows. You can see it's an important support resistance area. So I think that if we fail from here, looking at the long-term picture, I think we can go all the way down to 100, 101.
There were some guys talking a long time ago about 92 in a real bearish case, 92 yen. I think Jamie Satley, I think it was, yeah.
If you look at this, 94.77 is the 61.8 of the all-time low
move.
of the whole explosive move higher. Yes, absolutely.
Okay.
You can also draw, if we want to be looking at the long-term picture, you can also draw this support resistance area. So there is some interesting support there, 94 to 95. So let's
day at a time.
yeah, let's take it one level at a time, right? I mean, before we consider the possibility of seeing 92, let's first get to 105, because as you see, even on the weekly, 104.50 is important, because if we break that, I think there is not much stopping us to make it to 110.70 then, right? Then let's make it through 110.70, and then we can consider the prospects of moving to 94.77, etc., etc. But I would have to disagree with our friend there, meaning so far the long-term chart isn't looking bullish. Even if you see the type of a recovery we've had here, right? This isn't necessarily something impulsive. Quite the opposite. Look at the RSI as well. RSI in essence has reset to, more or less what you would expect resistance if we are about to continue lower. So, in order for me to turn in longer term time frames bullish, I want to see this triangle's trend line resistance breaking to the upside. Then yes, I'm on board. Until then, I'm very, very, very skeptical. Okay. I'm a seller of gold here for a revisit of 1450. What do you think? I think that's a good position to be in. I'm not a seller of gold. I actually own physical gold, and I think that gold is going, oh, sorry, we're still on the weekly. I think that gold is going a lot higher, but we are currently at resistance. So from a risk reward perspective, let me open it up here. So from a risk reward perspective, you're definitely in the right side of the trade, right? Because, I mean, if you're short here, we're currently trading at 14.77. You can have like a $13 stop loss above, let's say, 14.90. And then you can be looking for a move initially towards 14.53, which is like $24 lower. And why not, if that happens, even to a move towards 14.30, right? Which is another $20-something lower. So I can't blame you. I mean, yeah, we're still within this corrective formation, and there is absolutely no reason to believe that we can't actually keep on trading within this. And we're very close to resistance. So as I said, I'm very, very bullish in the long term. But if you put a gun to my head and you told me that I have to take a short-term trade here, I would also be short. Needless to say, though, if I didn't already make it clear, you don't want to be short if we break above like 1487, 1490, because I think you're going to be run over like nobody's business if that happens. I think that we're not looking back. Once gold breaks through 1490, I think it's going to be quite a fast move towards like 1556, the previous high, and then 1586, the 61.8 from the all-time high. So, you want to be short, that's your risk. Hey, you have David for an interview today, Coach.
Yeah, he's here. Okay.
Yeah, he just wrote in. Yes, okay. That he's here.
Okay, great. And he's under DAL. Okay.
Yes, DAL Capitals.
I wasn't sure he was going to make it, but great.
Why do people trade these crosses where the spreads are wide? That is quite a bit of commission being paid. Just wondering. Neil, the answer is very, very simple. If you are a scalper, yes, trading these crosses makes a lot less sense. But personally, when I go in a trade, I'm looking to make, several pips. I mean, especially when the market is more volatile, because, that's not the example now, but especially when the market is more volatile, I mean, I might be looking to make, catch moves of 2-3%. So for me, the spread is completely irrelevant. Even, either I pay 1 pip, or I pay 5 pips, or I pay 6 pips. In the grand scheme of things, if I'm looking to make 200 pips, 300 pips, 500 pips, I really don't care that much. So it depends on your trading style, right? So for my trading style, I really don't care about spreads.
Okay, thank you, Steve.
Okay.
5
Thank you,
after,
guys.
so 6 after. All right. Okay. So thanks, Steve and David. Thanks for coming in this holiday season to talk to us. And you're now unmuted. I'm trying to unmute you.
Can you hear me now? Hello.
Got you, David. How are you?
I'm doing well. How are you doing?
Good. Are you a paranoid bull?
I am a paranoid bull. I am.
Okay. Yeah.
I'm very much a paranoid bull, and
Okay.
it's great to kind of be back on.
You want to share
it's been an interesting.
Want to share your screen, or you want me to be showing?
Maybe you should show, just because of the screen I have right now might be tricky to get on.
Okay.
There are a couple of things that
okay.
that
Here
I
are the
think I was
S&Ps.
looking at this morning that I think that a couple of things that might be interesting to look at. Let's just kind of like the background of this moment is everything is awesome. The background of this moment is any bear is wrong. The background of this moment is also the president of the United States was impeached yesterday, but nobody cares.
Right.
So
things don't
I
matter
think,
until they do.
So one of the things that I think is also really interesting about this moment is that we now have had a record intervention. Actually, since we last spoke, we've had a record intervention in the credit markets by the Fed
funds overnight repo market.
By the QE, and that's when you start to get into that, you start to get into the jargon of kind of like why it's obfuscated and why folks are pretending like what has happened recently isn't as dramatic as it is, meaning that if we call it QE4 and we call it what it is, which is a resumption of the expansion in the Fed's balance sheet at a record rate, people start to get nervous. But if you say, well, it has to do with the mechanics of the overnight funding market and it's really just swapping reserves for treasuries, it kind of gives comfort. But I want to show just two charts, actually, 3 charts that I wish I was able to pull up on my screen. I don't know if you're able to quickly. But there's the Austrian 50-year bond, which is RAGB 38 of 62, or even the German 30-year. Either of those two.
Give me the symbol. Give me the symbol for the
okay,
German 30.
RAG. So the Austrian 50-year is RAGB 38 of 62. I don't know if you're able to pull that up.
RAGD I can't pull it up.
RAGB, G is in boy.
Oh, boy.
All right, boy.
Nope.
3/8. No? Okay, fine. Try the DBR zeros of 50. This is the German 30-year. I don't know if you're able to pull that up.
Could this be it? DBRC.
Let's...
DBRC?
No, DBR is the German 50-year. Is that it?
Whatever it is, it's you know, it's
No,
okay.
that's not it. That's not it.
Okay.
Digital equities. So, okay, the other thing you could pull up that's less pronounced, but it shows the
The
same story
30-year
is the
bond.
10-year U.S. Treasury.
Okay,
You
there's
can
a
bring
10-year.
up either the 10-year.
There's a 10-year.
Okay? And can you, so if you look at the U.S. 10-year, and actually the reason why I brought up,
Here's the
I
weekly.
wanted to bring up the, so if you look at that, that kind of hard reversal that happened at the end of the summer in September, the other bonds that I mentioned, which is the Austrian 50-year and the German 30-year. The same is actually true for the 10-year Japanese yen and also the 30-year Japanese, the JGBs.
Okay, so they're all can you hear me?
I can hear you. Can you hear me?
Okay, because when I talk, you just keep talking over me. All right. So
okay, go ahead.
all right. So all of these interest rate instruments are all showing a pattern, just different degrees. And I noticed when this correction in rates happened that it was the Bund, just like it led when rates were going down, was leading with rates starting to inch up. So is that what you're talking about? Is that the foreign bonds actually are showing more directional bias to higher rates than the U.S.?
No. So I think what happened, backing up a step, and the reason why the Austrian 50 years is a really, great example of this, is actually the opposite of what you're saying, but it's the same result, meaning that there was a blow off top that occurred in the overall credit markets and the global credit markets and the sovereign bond markets that occurred through August. And if what happened,
so those lows and yields, that's it. We can't go back to those levels. You're saying that was a major
that's
turn.
Correct.
Okay.
I think that was the absolute. And so just to kind of put it in context, and I'm sorry I'm not able to share this on the screen, but the Austrian 50-year from January of 2019 through its top on August 27th was up 38%.
Okay.
The price rallied 38%, and then from the top through today, which is basically from September, where you see that reversal in the 10-year U.S. Treasury, but you see it in bonds, you see it in
it's more pronounced
JGBs.
There. Yeah,
it's down 12%.
Right.
So
it's
what
more
happened,
pronounced.
in my opinion, it's got a lot more duration, but it's just a lot, the magnitude was greater, but what happened was, so all of this in the background, was occurring in the lead up to Draghi's final hurrah, which was, basically folks were front running, the idea that there would be, some additional intervention that the ECB would do in early September, which they did. Now, what happened following that, in my opinion, is that what we saw was, as I was mentioning, kind of a reversal in European long-dated government debt, but also European, credit markets generally. The 10-year started to reverse, the JGBs, not as much, but those markets started to reverse as well. And then, really importantly, that is when the overnight lending markets froze, meaning that what we started to see in September was a tightening of liquidity globally. Now, a lot of people talk about, a shortage in dollars and kind of, that there's certain regulatory reasons why, that there aren't, people aren't able, or the banks aren't able to provide liquidity to the overnight funding market because they need to hold certain reserves. But nothing changed regulatorily in September. Now people, some people say, well, it's the end of the quarter, and there's some tax,
Yeah.
cash, people need to raise, cash for tax reasons. But what happened, actually, more importantly, in my opinion, is that you had this big reversal in the overall credit markets that started to show up, and it showed up across all sovereign markets. It showed up, in corporate markets to an extent. And so what I think happened is that global liquidity started to reverse, and that, overnight money in the US, which should be risk-free, became risky, and it became expensive to fund. And what happened was that the Fed, I think, got nervous, understandably. So they tried to, stem the decline, with some short-term interventions that didn't work. And so they had to make those permanent. And now what we're seeing today is that, things have gotten so bad that there has to be a record amount of intervention, over, from now through January, hundreds of billions. And even now, if you look at overnight money, at kind of through the year, it's still not, as of a couple of days ago, it was like 3.5% still for January 1st, from December 31st to January 1st money. So backing up a step, the last time we spoke, the general kind of, you asked, am I a paranoid bull? I believe that cycles matter, and I believe that, that we're kind of like past the end of this cycle, which began, kind of going back 2009 with record interventions. And I think that central banks have reached their limits. And I think that this
so
year,
normally your normal look for cycles, as you say, every 7 years matters. So because of
7 to
Fed,
7 to 10. So
here we're looking at 11.
To
Right.
an extent, it depends on what you make of the last 2 years. Meaning, I think that 2018 was a proper into global expansion. And I think that 2019, we had a kind of a blow off top, reversal in credit markets. And that S&P has sort of been, yes, it is up. Vol's collapsed again. But S&P has sort of been an echo of that blow off top that happened in credit markets. So if you look at earnings, right, earnings are down in the S&P, and global growth has actually reversed. It's actually, it's been slowing. The U.S. economy has been fine. I agree with that. The business cycle actually didn't turn yet and hasn't turned. And so from a kind of, a business cycle perspective, yes, we're into like 11 years, and the business cycle in the United States has not turned. But if you look at China, things have actually started to slow quite dramatically. Default rates in China this year are at a record level year to date in the Chinese bond market. And so Chinese growth is slowing. European, growth is slowing, on the verge of recession of variety of countries, if not in recession. And so I don't know that I of course, if you look at the S&P 500 for sure, the cycle is continued, and the cycle's in the 11th year, and the cycle could go on, into the 12th year. But global markets peaked in 2018. Credit markets, we had this blow off in 2019, and it has started to reverse. So I do think that we are at the end of, in kind of this different sort of transition period than we've had historically. The thing that it makes this period very, very different and very bizarre is that in order to keep basic money functioning and basic overnight lending functioning, you've had to now have record intervention by the Fed, but nobody cares. And it's very bizarre. It's not something that, historically, if you had this sort of intervention, you had this sort of panic in the overnight lending market, you'd expect equity markets and volatility markets to react. But the fact that they haven't, to me, is unusual. I think it's also just a sign of the level of complacency, that exists in the markets today for all sorts of reasons. So I
So are
don't.
you, what's your
I mean,
preferred short, equities or bonds?
bonds. So I think shorting credit today is extremely asymmetric, and the reason for that is that, whether it's, the reversal in absolute yields, which we've seen now in a pronounced way, across the board, which, kind of provides some downside from absolute levels, or you look at spreads, which have contracted quite significantly across both high yield and investment grade. There's really a lot of downside protection to being short credit. I think shorting equities is great too. There's really no reason not to be short equities at record valuations and record margins, and shorting equities is, it's somewhat easier for folks. But the asymmetry right now of shorting credit is pretty unusual. One other thing to kind of
Does
keep in mind
currency
about,
play into this scenario?
so I think that so if we think about gold, and you think about Bitcoin, and you think about, alternatives to the dollar, I think that folks, want to believe that, and I think it's true that, on some absolute basis, what let me just kind of to circle around to answer that. What does it mean that the Fed is now doing a record level of intervention and, has agreed to monetize record deficits, and whether it is a continuation of the Trump administration or, his defeat by one of the Democrats, there's kind of a commitment to increased fiscal deficits, not even like consistent, but increased fiscal deficits at record debt levels. In my opinion, I think what that means is that, on some absolute basis, the value of, the dollar, on an absolute basis should be weakened, right? Because you're having a record amount of money printing that now, I guess, in a way, if we believe, that the short term, like 3-month move in S&P and the 3-month move in vol and kind of the sentiment that the markets don't care in a short term basis. I don't know if that's the right way to think about it, but at the very least, you've got a popular political backdrop with, the U.S. government on both sides kind of supporting a continued money printing. I think on an absolute basis, that means the dollar should weaken. Therefore, folks, kind of understandably think about gold and think about Bitcoin and stuff like that. I think that the tricky thing about currencies is that, if you look outside of the dollar, let's say you go to the euro, you go to the yen, the yen, on a relative basis, if you think about like the limits of what folks can do, there's really, the yen, it may be the place where the government's kind of reaching the limits of what's actually possible, meaning they own 70% of the bond market, they own 40% of the equities, right? They've had zero rates for throughout the curve for so long, and negative rates in the banking system so long that the banking system's now, arguably at a point of insolvency. Maybe it's like yen is kind of attractive versus dollar because they can't do anything else or something like that. Euro, I think that they are at their limits. I think Draghi knows that there were a number of central bankers in Europe who responded to the last round of easing by Draghi, saying that it was actually going too far. There's currently a case in Germany that's still outstanding where there's a legal challenge of the ECB's actions. So maybe in a way, the euro on some kind of relative basis to the dollar, they can't go as far because of they've reached the limits. But you have kind of like fundamental vulnerability in the euro to deal with, like deep systemic kind of political risk issues, given the general kind of lack of stability of that union. So to answer your question about currencies,
outside the dollar, you don't know where to go.
Well, I think that if you really had to,
well, no one really has to do anything.
Long,
I mean, we don't even have to trade.
I think that the thing to do, like to be short, is good, right? So when you're short, you can kind of generate alpha in a collapse. and you can generate increased value even if the currencies are devaluing. So you can be short on an absolute basis, all risk assets, and it preserves capital even even if we're in a scenario where the currencies are devaluing. I do agree with the notion, and I personally have some holdings in gold and Bitcoin, but I think that the reason why I don't start with that and I don't really end with that in any kind of pronounced way is that both of those are sort of uncertain and potential hedges, but it's not clear if we're in an environment. Let's say that I'm right, and that actually what happened is that liquidity starts to reverse very dramatically. After the blow off top in August, the Fed's been in full out panic mode, and what's happening over from now through the January, in my opinion, seems like panic mode. If I'm right about that, and it's it's also the case, there's still a ton of political risk out there, and we're at kind of the end of the cycle from a economic perspective. Valuations are high and margins are high, and so therefore it's likely the case that there's significant downside in both equities and credit. So let's say I'm right about all that, and let's say that for some reason there's some sort of recognition of that, and markets reverse in a violent way. In those sorts of environments, in the short run, gold and Bitcoin could get crushed in the short run, and that's because they can act like risk assets. And so the unfortunate thing about currencies is there's really nowhere to hide in an environment where all currencies are being debased and risk assets are at records. Meaning, if we were like in a different, so let's say if markets are down 40%, risk assets are collapsed, and currencies start to unravel at that point, I think to be long gold and Bitcoin with more conviction in that environment, as a large portion of your portfolio is safer. I think right now having it be a part of the portfolio, and it is part of mine, I think is reasonable, but you need to be thoughtful about the risk, kind of risk.
Because in a liquidity crisis, people will sell the kitchen sink to raise cash.
That's absolutely right, because they will act like risk assets, and they often do, typically do. Gold did, and as we see now, Bitcoin's got a ton of volatility, will continue to. So,
do you have any with your cycle work? Do you have any turning points or any type of time period that besides this end of year spike that Zoltan's talking about?
So I actually think that so in terms of seasonality, a time of year sort of thing, no. I mean, to me, the cycles are typically kind of 7 to 10 years. They typically, though, but I think the most important thing to pay attention to is credit markets. And that's why, whether it's looking at the European credit markets, US credit markets, Japanese credit markets, I think that the key thing to pay attention to, and this actually started to occur, is looking at triple Cs. So triple C bonds have started to sell off this year in the US. And oftentimes what happens whenever credit markets start to turn is that triple Cs will start to move first. And the reason for that is that that's the lowest rated credit. So, I think that looking at both triple C's, default rates, credit market volatility, we've seen pretty dramatically in the overnight lending market. But I think paying attention to, increased default rates, increased bankruptcies. We're starting to see some of this in kind of the consumer lending market. If you look at default rates in both consumer credit from a both auto-backed lending perspective and a consumer credit.
So here's the TLT. Let's get tactical now.
Okay.
It's a proxy for 20-year paper, sovereign paper.
Yep.
It's in a triangle. It's neutral. I guess you could say this was, your blow-off top right here. But this behavior so far doesn't seem impulsive to me. It seems corrective, and that we might even need one more blow-off high for the,
Well,
to
bring it
really
back.
declare a yield trough.
Bring it back to 5-year. Bring this same picture back to a 5-year view. And you'll see that you've had three consecutive higher highs, right?
Okay, here's a monthly.
Yep.
Okay.
So, and so I think that, in my opinion, kind of what we saw in 2016, if you remember back then, 2015,
Right here.
16,
Yeah.
was when, we started to have some credit market volatility. And then 2017 was when we had the dramatic global QE intervention. That's when equity market vol collapsed, right? This is when the S&P 500 had a Sharpe ratio of over 3 in 2017. So if you look at the ramp into 2019, right, we had a global economy sort of, in slowdown mode throughout 2018, equity markets globally collapsing, as you know, in January, at the end of the year in December, at the bottom, that's when you had this kind of like massive reversal. So I think that what happened kind of, if you look at the story of 2019, which is what you're saying, kind of up to that peak, that was the, well, they're going to save us again moment. Don't worry, everything's going to be okay moment. We're going to rush into, and it's two ways of thinking about that. One is like it's panic mode, yields are collapsing because we're afraid, but it's also let's hide in government paper because they're going to save us and everything's going to be okay moment. And in September, at that peak, that's when when everything reversed. That was just before the, that kind of final meeting, with Draghi. I think that is, I think one way of seeing this chart is that was the top and the moment where the ECB reached their limits, and then very importantly, just after that, like as this started to unwind, that's when the overnight money got expensive. Right, that's when the overnight money liquidity kind of dried up. Meaning, if it's the case that governments have limits, like maybe it's true. Okay, central banks have no limits. Maybe it's true that systemic risk doesn't exist, and maybe it's true that that we can hide in government money forever. That's possible, right? And if that's the case, then government bond prices can go up and up and up and up to infinity, and there's no risk in them. If it's possible, which I think it is, and if it's the case, which I think it probably is, that central banks have reached their limits, it could be that that was the top, and that was the moment when the market started to recognize, like, oh wait, maybe there are limits. And if I could think of a place in the markets where you would expect there to be no risk, overnight U.S. risk-free money should be the riskless, the most risk-free part of the market. And in fact, that's where it broke, right? Which is sort of interesting. If you think about, where might there be signs of systemic risk in the markets, or that, that the markets, that risk-free perceptions are breaking down. Well, maybe it's the S&P 500, I guess, eventually, right? Remember in 2008, like S&P went last, sort of, it didn't go first. Right. But to me, and so even tactically, I think we had 3 higher highs, and arguably maybe the highest in kind of the blow off top in 2019 in long-term rates. And the other thing to keep in mind about long-term money at this point is that, so let's say that I'm wrong, right? And that they keep it together, and that, that Bernie wins or Elizabeth Warren wins, and they do the Green New Deal, and then they have Stacey Kelton as the Fed chair. What do you think happens to long-term rates if you're printing double the amount of what's happening today? Meaning like a hyperinflationary. So there's like hyperinflationary scenarios where, it's that they somehow keep it together, but instead they print, rather than 2 trillion a year, they print 4. They start doing MMT and handing out. They take Andrew Yang's policy and they start giving people, money in the streets. I think that's also, quite, bullish for long-term rates or bearish for long-term paper, which is another reason that, if you're short credit, you kind of get both exposures, both the being able to be short this sort of, systemic risk, long-term debauchery of money, and also fundamentals, which are weak.
Okay, well, I want to thank you, David, for coming here near year end with your thoughts. And this is where you could follow David at Paranoid Bull. I don't think you've done much with your blog. Anything you want to announce that you're doing besides your own stuff?
Not right now. I'll have some more to share, sometime soon. And, but I very much appreciate reconnecting. And I also appreciate you're one of the few people who I know who openly speak about God on the internet, which I think is important. So keep up the spiritual work too. I think it's really important that we,
Oh, wow.
that we,
Thank you.
We prioritize that. And I appreciate
Well, like,
you being
a
an
lot of
example in
people
that way.
don't care for it, but I say I'd rather lose followers to be one.
I love that, and I appreciate it. You have at least one person out there
Okay.
who really appreciates that part of what you do. Merry
Christmas, David, and Happy New Year.
All right, take care.
And I hope that pips rain down on you in 2020, and that we're all riding the Wile E. Coyote trade to the bottom of the cliff, and we're on the right side with a parachute. Okay.
I'm with you, friend. Be well.
All right. Okay.
All right, take
My
care.
trading warrior
Bye-bye.
brother, David. Everyone have a great day. Remember, don't just count your pips, count your blessings, and we'll wrap up the week tomorrow. So that's it, everyone. I'm ending the meeting. Adios. You're very welcome, and see you tomorrow.